When trust in money weakens, central banks do not innovate. They fall back on gold. Why do central banks buy gold during crises? Gold may look outdated in normal times. It does not burn interest, does not grow like equities, and does not produce income like bonds. Yet during wars, inflation shocks, sanctions, banking failures, and currency instability, central banks across the world increase gold reserves aggressively. They do this because in a crisis, the goal is not return on capital. The goal is protection of the monetary system itself. 10 reasons central banks buy gold during crises. 1. No counterparty risk. Most financial assets depend on someone else honoring a promise. Government bonds rely on the state, bank deposits rely on banks, and currencies rely on confidence and policy. Gold depends on none of these. It is a physical asset with value that does not vanish when institutions fail, which makes it uniquely reliable during systemic stress. 2. Protection against currency collapse. Crises often force governments to print money, restrict capital, or run large deficits. These actions weaken the currency and reduce purchasing power. Gold holds value across borders and regimes, so when faith in paper money erodes, gold acts as a neutral and trusted store of value. 3. Strengthening central bank credibility. Gold reserves signal financial strength and discipline. They reassure markets and citizens that the central bank holds tangible assets, not just policy tools and promises. During panic, this credibility can stabilize expectations and prevent deeper loss of confidence. 4. Resistance to sanctions and asset freezes. Foreign exchange reserves held in dollars or euros can be frozen during geopolitical conflict. Gold stored within national borders cannot be digitally blocked or seized by foreign authorities. This makes gold strategically important during sanctions wars or rising geopolitical risk. 5. Balancing the risks of money printing. During crises, central banks expand their balance sheets to prevent economic collapse. While necessary, this raises inflation and credibility risks. Gold acts as a hard asset buffer, helping balance the perception of excessive monetary expansion. 6. Universal acceptance in extreme conditions. If trust in currencies weakens globally, gold remains widely accepted as a settlement asset. It is politically neutral and historically trusted, allowing countries to meet obligations even when normal financial channels become unreliable. 7. Reducing dependence on reserve currencies. Crises expose the risks of relying too heavily on another country's currency, especially the US dollar. By holding gold, central banks diversify reserves without increasing dependence on any foreign monetary authority, strengthening monetary independence. 8. Protection in negative real interest rate environments. During crises, interest rates are often pushed below inflation. This guarantees real losses on cash and bonds. Gold performs well in such conditions because it preserves purchasing power when holding money becomes costly. 9. High liquidity during market stress. Gold markets remain liquid even during severe financial panic. Central banks can sell or swap gold quickly without relying on fragile institutions. This liquidity provides flexibility when rapid intervention is required. 10. Ultimate long-term insurance asset. Gold has survived wars, defaults, hyperinflation, and currency collapses for thousands of years. Central banks do not buy gold to generate profits. They buy it because it still holds value when monetary systems fail. Final truth. Central banks buy gold when confidence in paper systems starts to weaken. Gold is not an investment for growth. It is insurance against monetary and geopolitical breakdown.